Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
So what I do is every weekend I go over my funky charts. They're ugly looking, but they mean something to me. Okay. So then I share them on occasion when they're at inflection point. So first, let's kind of like go back here. We had lots of selling underneath the surface that actually started December 2nd. And then we had another resurgence of that on Tuesday, Wednesday, February 18th. I warned the 19th. I said, yep, now it's starting. And we rolled over. We've had our correction, 10% SPY, 15% NASDAQ, but I still don't see buyers stepping in. A week and a half ago, I gave you my charts. Buyers are stepping away, and it was a 1-hour review of everything. They're still stepping away, was my point, even though we had come down into oversold. And I said, remember, markets can stay oversold. And then last Tuesday, the 10th, I warned, this is when VIX can come down into options expiration, so SPY can stabilize here. And we can have a little mini bounce into OPEX. That so far has been happening. Today we have the FOMC, all bets are off, and we got some more risk profile coming in. So this is what I basically wanted to share with you yesterday so you could take a look at it. This is the video of all the charts that I had from a few weeks ago. And then this is an update below. But first I wanted to give you some macro, which is money is still moving home. So, biggest drop in US equity allocation on record. So this is money managers. This is fund managers, equity allocation. They went bye-bye. And a lot of them did go again, chasing yields in Eurozone or China. But the point is, many people are hoping will be an outlier, and then the money will just reverse back into the US. I don't think so. They're not being incentivized to do that. So anyway, this is the market we have right now. Lots and lots and lots of revisions of those S&P 500 targets. If you remember at the beginning of the year, they were all like 7,000. I'm not wearing a 7,000 hat. No. So above 6,000 now, they say, requires reversal in inflation and trade war concerns. Recession would drive index below 5,000. And we're equally distanced, right? We're 5,500. We're right in the middle. So talk about hedging their bets. These estimates are coming down now for year-end SPX targets. And I should have listed, they were impressive. They were up to like 7,500. I mean, it was crazy. Moving down, this is the reason in large part, I would say, is GDP estimates are being ratcheted lower. And really, with the trade wars, we're trying to figure out, not we, but those who do modeling, I don't do modeling, they're trying to figure out what a hit the tariffs and such will have. So some are pushing, the CPI increase, but it's pretty well known it will bring down economic growth in the short term. In fact, some estimate it will only be, 1.5%. We're running at 2% now, annual GDP growth. Okay, some are estimating a hit of 5%. Well, that would put us in negative territory, which brings us into recession. So we don't know. But this is the stuff that I look for, where in 2022, we came down from a hard 35% pullback, 20%, that lasted pretty much all year until central bank coordinated global intervention in October of 2022. So they estimated that GDP would be really, really small. And in fact, we blew through it. Remember, NASDAQ advanced very solidly. In fact, 100% NASDAQ advance in 2 years. So they were, revising up GDP. We obviously had tons of stimulus, huge amount of government hiring. So that is the realized GDP, mostly from the government, not private sector, but still, now this is what they're expecting for 2025. And that's what's being ratcheted down. So anyway, I just want to kind of put that in perspective. Huge outflow of money, US equity selling under the surface. Lots of expectations of this being ratcheted lower, which is what also causes disappointment, et cetera. So I put some stuff in here of how tariffs would also impact companies, and that's also trying to be figured out because many believe that Trump won't follow through with these tariffs. So they're like, we don't really need to sell because he's really just kidding. But I believe he's not kidding. So I'm more bearish because I believe he's not kidding. This is how these trade wars and tariffs can hit. 41% of revenue in S&P companies comes from abroad. And of course, goods making up a big chunk of the US imports from Canada, China, and Mexico is a hit to GDP. So anyway, that's all the re-rating that's coming in slowly but surely. Analysts haven't even really done any earnings estimate growth growth rates, they haven't taken them down. They're still very, 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 very positive across the board, but they're always the last ones. So I put all of this here as somewhat the macro backdrop, and then I go over my intermarket chart. So when you get a chance, you can kind of take a look. But in a nutshell, volatility is not done. Big picture, I've said this is the year of volatility. And these are my ugly charts that basically say they're coming up off the ground like I expected, but they haven't even played catch up yet. They haven't even hit some levels. They got to then get up here and then roll over. Anyway, long story short, lots of these indices that I cherry pick with my own indicators over them are tools for me to tell when the selling is overdone and then we start to move higher. And I don't even have any blip. We're still like on the floor. So that's the kind of stuff that I do. And then, of course, just some technical analysis. NYSE, for example, has a nice little trend line here from the COVID low to the 2022 global central bank intervention to the November 1st, 2023 Fed pause and Yellen Yahtzee. So we've got lots of room to come down still. And indicators are bearish. And you can kind of see where I highlight that we still have to stabilize before we can even have a bounce in this guy. So that's why I said yesterday, it wouldn't surprise me if we had another, 3 to 5% drawdown. Anyway, the point is lots of big long-term charts, which is a monthly NYSE, are also kind of intonating. You can see this head and shoulders over here, intonating weakness has not even come into the market yet. And I love this type of thing. This is when it's really great to have money invested. And then it says, nope, we're going to plateau here. And then this is a really not a great time to have money invested. Get the idea? It's really simple. Climb the mountain and then go back down. And sometimes you have some little bumps and they don't look very viable, but this has been a hell of a long hike. And now we're coming back inside the mountain after. So we're in plateau mode. Anyway, these are some of my funky little reads, but that's what I do. I try to connect the dots. I'm a solid generalist, not into the plumbing mechanics of repo, all of these very, very specialized spaces. I like to look at lots and lots and lots of data and make a story with them. And these charts are also very helpful to tell me the intensity, the duration, and the direction. So for example, when we had the August 5th convexity short covering rally, the S&P 500 stocks above their 200-day were still firmly above 65, which for me, my cherry-picked line in the sand, is very bullish. We broke below in December. Like this broke below, bounced into that February, mid-February, and then dumped again. So can we bounce? Sure, but anything below here is busted. So I'm looking for this stabilization and move higher before I can get excited about these kind of swing longs. But that is selling. That is impressive. That's why I study this intermarket, because it says this is much different. Even if the degree of drawdown, 15% in the last month versus the 15% on the July to August yen carry trade unwind are the same amounts, the breadth underneath the surface is decimated. Very different. Very, very, very different in my book. So anyway, that's why I'm so kind of focused on breadth and net selling and all that. Here's your August 5th convexity rally. Popped right up like a daisy. This took a while to get down here. And does that look, I don't know, anything? It looks oversold, but it's got a base and move higher. This could be a little while. Same thing with my growth value. Is it oversold? Absolutely. Should we have a bounce? Sure. But this is bear market when it's below zero. This is bear market when it's below zero. So the only way that I am highly convinced that we're back in bull market is we get back above the zero, period. So we have a different reflection. That's not the word. Coffee. Anyway, this is the divergence. I've shown this to you before. This is concentration risk unwind, and this is RSP, which is value. Anytime you have defensives outperforming Mag 7, you already have a bear market feel. We're in a bear market already. Anyway, this is the dollar falling. We talked about that. Money goes home. It's still going to fall. This is the China wall breaking out. Money's still rotating there. Despite Besant coming in yesterday talking about money controls, we're talking capital controls. And Trump with his February 21st, I might add, executive order right when the market started to dump. So I warned on the 19th, we had softness on Thursday, we had a dump on Friday, Friday night, the executive order, and there you go. That market fell strongly from there. Anyway, this is gold. That's a happy face, which means it's still very, very, very bid. And then gold relative to SPY is very, very, very bid. And credit spreads are also getting very, very, very bid. Can they come back down? Sure, but I don't like the look of this.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.